Yes, good morning everybody. My name is Dr. Sastry, Head of the Department of Commerce and Management, K.B.N. College. Now, I am going to take first TP, Income Tax, Unit 1. The topics to be covered in this video is meaning of tax, types of taxes, objectives of tax, next constitutional structure of Indian tax, and definitions pertaining to income tax, that is agricultural income, SSC, person, income, assessment year, previous year, and exceptions to the previous year. Next, what is gross total income? So these are to be discussed in this video. Yes. First one, meaning of tax and types of taxes. Tax is compulsory contribution made by citizen of a nation to meet various expenditure of state. General term state means Andhra Pradesh, Kerala, Karnataka, like that. But in broader meaning, in civics meaning, state means it is a country. So tax is collected from the citizens for the expenditure to the state, which means for the welfare, for the safety and others. So taxes are of two types. One is direct tax and indirect tax. So what is the direct tax? Direct tax means it is a kind of tax where incidence and impact both are on the same person. Incidence means liability to pay tax, and impact means burden of paying tax. These two are on a particular person, so that's why it is direct tax. Levied on one particular person and paid by such person, that is called direct tax. Examples for direct tax is income tax and professional tax. Next, indirect tax. It is a kind of tax where incidence and impact is on two different persons. It is levied on one person, paid by another person. So that's why it is called indirect tax. So examples for indirect tax is GST and customs duty. Next, objectives of tax. Why tax is to be collected? Tax is to be collected from the public to raise the revenue, to regulate the production of certain commodities, to control the consumption of certain harmful commodities, luxury commodities, to control monopoly power in some people, to redistribute the income. Next, to protect infant and domestic industries, to prevent dumping, to maintain balance of payments, to curb inflation, to regulate business activities. So for these objectives, tax is levied on the public. The constitutional structure of income tax is, there are three-tier federal structure. One is union list. It contains those matters on which the central government has power to make laws. Next, second one is list 2, that is called state list. So it has only those matters on which the state government has the power to make laws. Next, third one is concurrent list. That is, has those matters on which both the central government and state government have to power to make laws. So the list of the taxes which we collected from union list will be listed here, and state list is also in another slide. Next, definitions. Agricultural income. As per section 10, subsection 1, agricultural income earned by a taxpayer in India is exempted from tax. Here, one must have to get the clarification for this statement. If an assessee having only agricultural income, it is exempted from tax. If a person having agricultural income as well as non-agricultural income, it is integrated and there is a procedure for levy of tax. Agricultural income is defined under section 2 subsection 1A of Income Tax Act. So, as per this definition, any rent or revenue derived from land, and such land must be situated in India, and such land is used for agricultural purposes. So that which means the person should conduct basic operations and subsequent operations. What are basic operations? The operations which we conduct before harvesting is called basic operations. Operations which we conduct after harvesting is called subsequent operations. So these two must be conducted by the farmer. Next, any income attributable to a farmhouse subject to satisfaction of certain conditions specified in 2(1)(a). So that is agricultural income. Next, SSC. SSC means a person who pay tax or any other sum of money is payable under this act. So we have to observe, even he is not to pay any tax, but any other sum of money means by means of penalty, by means of interest and others. Under this act is called SSC. SSCs are three types. One is normal SSC, second one is representative SSC or deemed SSC, third one is SSC default. An individual who is liable to pay taxes for the income earned during the financial year is known as normal SSC, which means a person who pay tax on his own income is called ordinary SSC, normal SSC. Next, representative SSC or deemed SSC is a person who pay tax on behalf of the third party, that is called representative SSC. So this may be on behalf of minor, on behalf of others. Next, SSC in default. SSC in default means he is a person who has failed to fulfill his statutory obligations. For example, if an employer pays salary to employee, if employee salary exceeds the basic exemption limit, the employer has right to deduct tax at source, and if so collected tax must be deposited in a government treasury. If employer failed to collect the tax at source, or if employer failed to deposit the so collected tax in government treasury, he will be known as SSC in default. Next one is Dept person. According to section 2 subsection 31 of Income Tax Act 1961, a person includes an individual, male or female, minor or major, etc. A Hindu undivided family, which means a combined family as per the laws, as per the schools persisted, that is VIJAYAWADA and Dayabaga, and a company means it is an artificial person created by law, having perpetual existence, common seal and separate legal entity, is a firm means partnership firm, an association of person or body of individuals, which we called AOP or BOI. AOP means association of persons. So in AOP, the members may be an individual, HUF, company, firm, local authority, or any artificial juridical person. But whereas in case of BOI, only individuals are the members in BOI, which means Rama, Krishna, Manohara, like that. So next, local authority, Vijayawada Municipal Corporation is the example. Next, any artificial juridical person, maybe anyone. Next one is income. Income is the Income Tax Act, Section 2, subsection 24, gave the inclusive definition of income. So it includes profits and gains, dividend, voluntary contribution received by a trust, the value of any perquisite or profit in lieu of salary taxable under Section 17, subsection 2, class 3, any special allowance or benefit for the performance of duties, city compensatory allowance and dearness allowance, any perquisite or benefit to a director, any perquisite or benefit to a representative to SSE like trustee, any sum chargeable to income tax under Section 28U and 3, 41 or Section 59. Next, any capital gain taxable under Section 45, insurance profits, income of cooperative society for banking business, any winning from lotteries, crossword puzzles, races, including horse races. Next, any sum received by SSE as his employer's contribution to any provident fund, superannuation fund, or fund set up under the provisions of ESI, etc. Any sum received under K.B.N. insurance policy, and an aggregate amount of gift or gifts received exceeding 50,000 as consideration. Next, assessment year. Assessment year, as per Section 2, subsection 9, assessment year is a period of 12 months, commences from 1st April of this year and ends with 31st March of next year. For current for instance, the assessment year 22-23 will commence from 1st April 2022 and it ends on 31st March 2023. So assessment year is also known as tax year. Why? Because income earned in previous year will be put to tax in this year. Next, previous year. According to Section 3 of Income Tax Act, previous year means it is a financial year which is immediately preceding to the assessment year. So this is for running business. In case of newly established businesses, it should not be 12 months. It should not be 12 months. If a person starts his business on VIJAYAWADA'S, so his previous year starts from Dasara to 31st March of the next year. If a person starts business on auspicious day of Ramjan, his previous year starts from Ramjan to 31st March of next year. If a person who starts on 1st January, his business starts from January 1st to previous year starts from 1st January to 31st March. So this is also known as income year. So for 2022-23, previous year should be 21-22. Next one is, there are some exceptions to previous year. So general statement is, if you earn income in previous year, will be put to tax in current year, which means assessment year. There are certain exceptions. That is, the exception is when we earn money in previous year, it will be put to tax in the year itself. Why? Because there are some conditions, exceptions. One is income earned by a non-resident through a shipping company in India where no representative is in India. In such case, the tax is levied in the year which he earned the income. Second one is income earned by a person who is leaving India permanently or for a long period. So a person who leaves India and he has no intention to come back, in such case, we collect the tax from him in the year which he earns income or which he possesses the property. Next one is income earned by those bodies which is formed for the short period of time. There are some organizations which are established for short period. So after completion of their job, the organization will be closed. In such a case, the tax is levied in the year which it is earned. And the another one is income earned by those persons who are likely to transfer their property in order to avoid tax. So, to avoid the tax, certain persons are transfer their properties from one person to another person. So that's why in such a case, the tax is levied in the year which he possesses. Next one is income earned from a discontinued business. Suppose if a business is discontinued this year by running a certain period, then he has no intention to continue further. In such a case, tax is levied in the year which it is earned. Next one is gross total income. As per section 14, gross total income means the income of an assessee is divided into 5 heads. That is salary, income from house property, profits and gains from business or profession, capital gains, income from other sources. Each head having its own deductions. By adding these 5 heads and applying a clubbing of incomes and making adjustments of set-off and carry forward losses, the derived amount is called gross total income. Thank you, one and all.